Let's talk about the S word. Nope, not that one. Selling your business. For a lot of owners, even saying those words out loud feels uncomfortable, emotional, almost disloyal. You probably poured years of your life into building this thing. Late nights, missed weekends, real personal risk. So the idea of selling it can feel strange, even if you've thought quietly about it for a long time. But here's the reality most owners don't like to face. Every business owner exits eventually. The only difference is whether that exit is intentional, well timed, and rewarding, or rushed, reactive, and disappointing. So let's talk about what selling a business actually looks like in the real world. So, a little bit about me, I'm a licensed business broker in Florida, so I'll speak from my perspective in my state, but the principles we're going to talk about apply far beyond Florida. They hold true across most of the US and Canada and in most international markets as well. So, we're not going to talk about the fantasy of selling a business, we're going to talk about the real one. And the reality is, if you're like me, you see a lot of things in your social media feeds from coaches, experts, entrepreneurs, and some really amazing speakers who have done well, or at least they say they have. And they will get you really excited about selling your business for a whole lot of money, which is very, very possible. But what they often don't get into, and this is why I wanted to create this video, is they don't get into the real details, the things that require a lot of thinking and a lot of your time to figure out before you sell your business. And they don't get into the details of what it actually takes to sell a business for top dollar and really everything that you'll need to go through in order to list your business and ultimately sell it. So we're going to talk about that today. Before anything else, let's set clear expectations. Selling a business is not usually a fast process. It often takes months, not days or weeks. It isn't passive and it definitely isn't guaranteed. When you work with a business broker like me to sell a business, it is a very involved process that requires a lot of trust and a lot of work. Selling a business is a great way to shine a light on everything in your business that's been ignored or possibly overlooked for years. Anything from financial shortcuts to owner dependence, customer risk, undocumented processes, informal agreements, the things that don't really seem urgent until someone else is considering buying your business. Then they become very, very important. This is why a large percentage of businesses that go to market never actually sell, not because they're bad businesses, but because buyers don't trust what they're seeing. And trust is the currency of transactions. Florida is one of the most active markets in the country for buying and selling businesses. There's a steady demand across industries, across deal sizes, and across buyer types. So I'm speaking from the experience of someone who lives in a state and sees a lot of transactions where there's just a lot of movement and a lot of people who are buying and selling all the time. At the same time, the number of active brokers relative to that demand in Florida and across the United States and probably the world is relatively small. The result is there's a market that moves quickly, attracts a lot of interest, and occasionally lacks consistency in execution. So, one advantage Florida does have is its structure. The Business Brokers of Florida MLS system creates a centralized marketplace that allows brokers to cooperate, share listings, and expose businesses to qualified buyers efficiently. I just mentioned that because many states don't have anything like this. And in some places, licensing is not even required to sell a business at all. So the key takeaway in that is it's okay if you're not in Florida, and it's okay if you're not selling or buying a business in Florida. The market does work pretty well across the United States, but you need to know that your outcomes are likely to be different depending on which state you're in, because some states do not require licensing and some states don't have an MLS system for businesses to be listed on so that buyers can get accurate information about those businesses. If you go to websites like bizbuysell.com, they're great for getting ideas, but oftentimes the information is sparse and not accurate. And here's the dirty truth: a lot of brokers, especially outside of Florida, will post businesses on BizBuySell and other websites or Facebook Marketplace just to get buyers, just to get people to call them. So you need to be careful to look out for that. Outcomes depend heavily on preparation, professionalism, and execution of your broker. So choosing the right broker is very important. And that leads directly to valuation. You've probably heard people talk about getting a good business value or a valuation for your business. And that's definitely not the only thing that brokers do. It's really just a starting point for the process of working with a customer from a broker's perspective. One of the most common things that owners hear is your business is worth three times what you make. Sometimes it's said as three times your profit. Sometimes it's said as three times revenue. Either way, it's almost never true. Businesses are not valued on revenue. They're valued on cash flow, among other things. Revenue shows activity, cash flow shows sustainability. Two businesses can generate the same exact revenue and be worth dramatically different amounts depending on margins, consistency, and risk. A business doing $2 million in revenue with $300,000 in clean, repeatable cash flow is fundamentally different from one doing the same revenue with thin or volatile profits. Most small businesses are valued using seller's discretionary earnings, which reflects the total economic benefit an owner operator is likely to receive. Larger businesses, or those appealing to institutional buyers, are valued using something called EBITDA, EBITDA. In both cases, the multiple is applied to normalized earnings, not top line sales. When someone gives you a valuation without deeply understanding your numbers, they aren't valuing your business, they're guessing. Timing is another reality that catches owners off guard. As a broad guideline, if a business is not generating at least around $500,000 in annual revenue, it may be premature to sell. I know we said that your business is not valued based on your revenue, but that $500,000 in revenue, at least in Florida and probably throughout the United States, that's a good baseline number to know. Is your business healthy enough to even consider selling? If not, I recommend probably continuing to build your business, increase the revenue, and increase all the things that help you get more money, more cash flow coming into the business. It's not impossible to sell a business that's worth less than $500,000 or that has less than $500,000 in revenue, but it is more difficult in most cases. Below that level, the buyer pool shrinks dramatically. Financing options become limited, and deals tend to revolve around lifestyle rather than scalability. Valuations are often capped regardless of effort. In many cases, the smarter move is to pause, build value intentionally for 12 to 24 months, and then sell from a position of strength rather than urgency. Selling from strength almost always leads to better outcomes. To support a valuation that buyers will actually respect, the financial picture needs to be clear, consistent, and credible. Another very general, broad stroke marker for you to consider when you're thinking about selling your business is, do you have multiple employees? If it's just you or just you and a spouse running your business, there's a very, very good chance for a variety of reasons that your business really shouldn't be sold and may not be able to be sold. Again, there's exceptions to everything, but just keep those things in mind. And this typically means that multiple years of financial statements, a clean trailing 12-month view, balance sheets that reconcile, and tax returns that support the story being told are really important. If you don't have those things, maybe consider building your business and getting those things in order before you consider selling. On top of that, buyers expect a detailed add back schedule. So, add backs are the things that are not easy to see in your maybe documented financial records. It could be owner compensation, personal expenses run through the business, one time legal or consulting cost, unusual repairs, discretionary travel or vehicles, anything that won't continue under new ownership. Add backs are normal, and poorly documented add backs are not. So we will have to document those add backs when it comes to assigning a value to your business. If add backs are vague, overly aggressive, or inconsistent, buyers will discount them immediately. In many cases, they'll assume the worst. Beyond the financial statements, buyers want clarity: revenue by customer, revenue by service or product, seasonality, customer concentration, payroll structure, what the owner actually does day to day, what happens if the owner steps away. They want to understand what assets are owned versus leased, what debt exists, what working capital the business actually requires to operate. They want to know if real estate is involved because that introduces a whole other layer. In many cases, it's a good layer to add, but it is another layer that requires deeper thought and consideration. In most cases, the business and the real estate are sold as two separate transactions. They may close together, but they often involve separate financing and sometimes even separate buyers. They're related, but they are not the same thing. None of this needs to be perfect, but it all needs to be believable and accurate. Which brings us to the deeper question buyers are really asking: What makes this business valuable? Strong financial performance matters, but it's only the starting point. Buyers look closely at growth potential. They want to see opportunity that doesn't rely solely on the current owner's effort. That could be pricing leverage, operational efficiency, untapped markets, or underutilized capacity. Owner independence is critical. The more a business depends on the owner personally, the harder it is to transfer to someone else. Documented processes, trained teams, and leadership depth all reduce risk and increase value. So, again, if you are effectively the only employee in your business, it might be very difficult to transition it to someone else. Predictability matters. Recurring or contracted revenue gives buyers confidence. If you have long term service agreements, that's a really good thing when it comes to what potential buyers are looking for. So, service agreements, subscriptions, retainers, and long term customer relationships help stabilize future cash flow. Customer concentration is another major factor. Heavy reliance on one or two customers creates risk. Diversification builds confidence. Differentiation and defensibility also play a role. If your business is easily replaceable, buyers treat it like a commodity. A clear niche, specialized expertise, reputation, or proprietary process creates leverage. Leverage is good. Finally, organizational strength matters. Buyers want continuity, teams that stay, systems that work, a culture that doesn't require the owner's daily presence to function. These factors don't just influence price, they influence whether a deal survives diligence at all. At this point, it's worth clarifying what a business broker actually does because there's a lot of misunderstanding about that, about what people like me do. So, a good broker doesn't just list a business. A broker helps establish a realistic valuation, position the business for the right buyer pool, and create marketing materials that protect confidentiality while telling a clear story. They screen and qualify buyers, manage communication, negotiate terms, coordinate due diligence, and help keep momentum through financing and closing, all while keeping a lot of this a secret from your employees and other people who just don't need to know that you're trying to sell your business. In many ways, a broker's role is to manage risk, manage expectations, and keep the process moving forward when emotions and uncertainty inevitably show up. As for commissions, 10% is a very common benchmark in small and lower middle market business transactions. My commission is typically around that range and can vary depending on size, complexity, and structure of the deal. In broad strokes, expect to pay a commission of 10 to 15% to sell your business. Larger transactions often carry lower percentage fees, while smaller or more complex deals may be higher. The fee only makes sense if it increases the profitability of a successful close, protects value, and prevents costly mistakes. The final reality is this: selling your business isn't about luck, it's about finding a perfect buyer. And it definitely is not about applying a simple multiple to your revenue. It's about preparation, it's about credibility, and it's about building a business that someone else can confidently own. Florida is a strong place to sell a business, so are many other markets. None of them are forgiving to unprepared sellers, though. A good exit doesn't happen by accident. It's built long before the business ever goes to market. If you have any questions about selling your business, you can always reach out to me, Ryan at ryancwinter.com. You can also visit my website, ryancwinter.com. You'll find more information in the description of this video. And again, feel free to comment, email me, or otherwise just reach out if I can do anything to help you achieve your goals in business. Thanks for watching.